I'm Lee McDonald with AM Best. Welcome to our webcast, State of the Captive Insurance Market. A panel of AM Best analysts and industry experts will review the issues shaping the captive insurance market, including financial results and business environment for captives, RRGs, and related organizations. We'll meet our panel in just a minute. We might mention the subject of financial strength ratings. In fact, we probably will. A full explanation of AM Best's ratings is available online at ambest.com/terms.html. And finally, the opinions expressed by the panelists are theirs alone and do not necessarily reflect the opinion of AM Best. And if you have any questions or comment, please send them to webinars@ambest.com, and we'll recognize it during the event. So let's meet our panelists. I'd like to start at the end of our panel here, but we'll move through all of them as well. I'd like to welcome first Michael O'Malley with Strategic Risk. Michael, could you please just explain your organization and your role in it?
Yes. My name is Michael O'Malley. I'm a Managing Director with Strategic Risk Solutions. We're a captive manager and consultant. So we handle the front end of the captives, assessing feasibility for entities considering a captive, and then once operational, we do the back office management for captive insurance companies, financial reporting, regulatory liaison work, just supporting the operations of the captive once established.
Okay, thank you. Susan Molyneux is with AM Best. Susan, could you talk about your job and what you do at AM Best?
Right. I am an associate director responsible for a team of analysts that follow the captive sector globally.
Okay, great. And Ed Malaspina with HAI Group.
Right.
Your organization and what you do there?
Yeah, I'm the president and CEO of HAI Group, and we provide a large to public and affordable housing authorities insurance products and services, and we do it nationwide.
Okay. And Fred Islami with AM Best, welcome.
Thank you. I'm Associate Director. I've been with AM Best for the past 10 years, exclusively dedicating my life here to captives.
Okay. All right, why don't we get started with Fred? We'll touch a little bit on some research that you're releasing very shortly. We do that every year. Captives is really a big world. There are quite a few out there, all different types. Could you talk about the organizations that AM Best and the team you're involved in follows?
Sure. Giving a background, going back to 56 years ago when Fred Rice created his International Risk Management Limited in Bermuda. Since then, both regulations for captive and also captive companies have spread throughout the globe and the U.S. So this slide that you see is based on the information that SRS published a few months ago. Marsh came back in May showing 6,500 captives globally. So as you can see, going back to 1962 when we only had one captive, the expansion of the captive throughout the world and the U.S. And the captive regulations by states have increased tremendously. AM Best rates currently about 200 captives globally. You'll see the breakdown of domiciles on the slide on the Exhibit 2. We have a number of offices that we dedicate to a specific domicile. From our U.S. office, we rate about 140 U.S. domiciled captive companies and Bermuda as well. And our Mexico, London, Hong Kong, and Singapore offices have captive teams that they dedicate themselves to the captives which are domiciled there. These companies, as you can see on slide 3, are separated by RRGs, which is exclusively a U.S. entity, and we have both single-parent captives domestically and single-parent captives internationally. and also the rest fall into other types of captive, which include captive group captives, cell captives, and other type of alternative risk transfer companies. So that's basically the universe of captives that AM Best rates. As we end this webinar, we'll go through the rating distributions for those captives as well.
Okay. And just drilling into what the universe you just talked about of rated companies, is a component of RRGs,
Right.
the risk retention groups. How'd they perform?
Performance for RRGs and also other types of captives, they've been excellent. I think Ed can talk about RRG more specifically because he's the president of one of the largest housing RRGs. But overall, we have seen first of all, we look at the net premium written for this universe of 43, 44 RRGs that we have. The premium have been relatively flat during the past 5 years, but the surplus has increased from 1.9 billion to 2.5 billion during the past 5 years, which shows a good chunk of money has remained within the RRG groups. And also we note that there's about 228 million in terms of dividends that goes to the policyholders for these RRGs, which is a good retention practice for the RRG companies to hold their members, to keep them members. And I'm sure Ed will talk about the benefit that they get, the members get, and the reason that they would stay with the RRG.
Okay. Susan, could you just talk for a moment here about how AM Best approaches this population from the rating perspective? How do you rate these kind of organizations?
Sure. Well, AM Best has rated captives for decades, and we apply our rating methodologies to companies globally, but we do have separate methodology that considers the factors specific to captives. That's the alternative risk transfer criteria. In October of last year, our credit rating methodology, or BCRM, was updated. The elements of our ratings did not change at all. However, we introduced the building block concept in order to provide more transparency to the rating process. Exhibit 13 of our upcoming report shows the building blocks, which begins with a balance sheet assessment, which is the foundation for financial security as the starting point for the rating and the point from which all the building blocks are notched. Risk-adjusted capital, as measured by Best Capital Adequacy Ratio, or BCAR, is one consideration of the balance sheet assessment, but the other components of the balance sheet are also assessed on a quantitative and qualitative basis. Exhibit 15 shows the captive sector as a whole has a balance sheet strength that is considered at least strong, with 60% considered strongest. This reflects the high risk-adjusted capitalization, a pattern of stability, strong reserving practices, and high quality of capital. This is not surprising, considered that capital preservation is a key element of the captive business model. AM Best also takes into account letters of credit and loan backs when assessing the strength of the captive's balance sheet. We then look to operating performance, the next building block, and that considers profitability, stability, diversity, and sustainability of earnings, as well as the impact of prior year liabilities on earnings. We take into account features specific to captives here, such as cost sharing that helps keep expenses low and strong loss control, since the captives are very close to the risks that they write. Exhibit 17 shows our assessment of operating performance for the captive sector, which overwhelmingly falls into either the adequate or strong assessment categories. The operating performance assessment is not simply a review of the numbers. We're looking at results before and after dividends, and we're also taking into account that some captives, particularly those with a narrow scope, may have bumpy results. We're looking to the parent's track record of support when making our assessment. And in the case of RRGs, we recognize their performance which exceeds the commercial casualty counterparts. We're next looking at business profile, the next building block, and the captive sector here is predominantly limited, with nearly a third considered neutral, and this is seen in Exhibit 19 of our report. When assessing business profile, we're looking at geographic and product line diversification. We're looking at leadership position in the market, control of distribution, and other factors. The rated captive sector is diverse, but some have a narrow focus, and others are very diverse, writing in multiple territories and multiple lines, and that's reflected in our assessment where some are limited and some are broader, which results in a neutral assessment. And our last building block is ERM, where we're assessing the captive based on its nature, scale, and complexity of operations, and nearly all the captives here are assessed as appropriate. In the captive sector, we have companies that have their own ERM framework, and we also have captives that are an extension of the parent's ERM framework. So we spend a good deal of time here getting to understand the companies and the ERM environment in which they operate in light of their business profile. So the building blocks will result in an issuer credit rating, an ICR, and largely the captive sector is in the excellent rating category, and they are largely stable. And this here confirms the strength of the captive market and a reflection of the proximity to the risks written, the quality of data, and the involvement and support of the captive owners.
Okay.
To add
Go ahead.
to Susan on the ERM, in the fact that the company has its own ERM and it's tied closely and intimately with the parents is also augmented by the fact that the captive manager typically has a very strong ERM program, which makes the ERM for these captives very strong. Although we go with the appropriate, but there is a third layer of enterprise risk management which governs the captive insurance companies.
And I think the bar for appropriate is already pretty high.
Exactly, yeah.
Why don't we, we'll come back to the report. By the way, I just want to mention to the people who are viewing that this is a report that's going to be issued this week, I believe. It's in its final stages that I saw, and those are the exhibits that you've been watching lately in the past few minutes that Susan and Fred have been referencing. They're all in that report. Michael, very quickly, Fred mentioned ERM, and you have a pretty broad perspective on captives. What are you seeing in terms of enterprise risk management? How widely and deeply is it being adopted?
I think it's being adopted across the board. We're seeing more and more, at least internally at SRS, we've gone out to SAS 70 reviews and taken the extra step to have an external party come in and monitor how we do things, our internal controls. But we're seeing that on the same at the client level and the captive management level. So overall, significant increases in compliance and requirements related to ERM. When we manage a captive, we also have imposed certain guidelines in terms of constant performance monitoring. So we have a loss scorecard system and other systems that on a monthly basis assess performance. So there's no lag time in claim activity, increases in claim activity and the responsiveness to it. So overall, I would say just a broader expansion of ERM across the board is what we're seeing.
Okay, Ed, what does ERM mean to you and your organization?
Yeah, in the last 2 years, we've made a significant investment in the resources that we have in-house for ERM. We own the ERM activity in-house. We have a committee that operates in-house. We also have a committee at a governance level for ERM. We have a person designated and assigned to the ERM responsibilities. We have an approved appetite statement. We have a reporting tool. And we have trained our entire staff on recognizing the risk factors that come with our business.
Okay, Susan, I just want to jump back to the report there for a quick minute here. Underwriting results. What have you seen in terms of captives' performance, especially around combined ratios?
Well, we do find that time after time, the combined ratio beats the commercial casualty composite. And I think touching back on ERM, it is usually, in many cases, a reflection of the effectiveness of the ERM framework, and it translates into the combined ratio. So although we have these building blocks, they do very often feed off of each other. So the benefits of a good ERM framework will translate in many cases into an improved combined ratio because the results are within the appetite and tolerances.
Yeah, I think if we go to Exhibit 6, we can give more detail on this, comparing the captive composite and the commercial casualty one. You see that there's a 9.4 difference between the loss and loss LAE ratios between the two composite. Expenses, as you can see, is much lower than the commercial ones, 18. As a result, combined is actually almost 18, 20%, 11% lower than the casualty composite. Another factor that we look at is the operating ratio, which for captives is about 69 versus about 86 for commercial one. There are reasons behind it, and the document, the paper, the report that we have identified the reasons. I don't want to take time of this webinar to talk about the reasons, but they're all valid reasons. We have been repeating them for the past 18 years. Every report we've had, we identified the good reasons. One, of course, is the amount of attention and money that captives spend on loss mitigation and loss prevention. And at the same time, they're able to dividend their policyholders and their stockholders huge amounts of money. If you look at the actual, bear with me, if you look at the Exhibit 4, which shows the entire universe of U.S. captives that we rate, you'll note that again, that the premiums have remained relatively flat, so are the loss and LAE reserves. But you see that the surplus has been increasing from 19.6 to 23.3, meaning there is a 3.7 billion in increase in surplus during the past 5 years alone. At the same time, these companies paid 1.7 billion in dividends, meaning the total of 5.6 billion actually remained within these companies or given to their policyholders or stockholders instead of spending this money on commercial insurers. So these are the benefits that we see from the captives.
Okay, just sticking with one slide ago with the underwriting results, the combined ratio. 2017 was a tough year for a lot of property insurers. We see it in the results now.
Right.
What do you see in captive results?
The captives, it did affect captives as well because you have a bunch of cat events in the south and in Puerto Rico, in Florida, Texas, and that brought the combined ratio to 91.4 for the captive, almost 9 points from last year's. And that's basically the impact of those cat events. But overall, you look at the 5-year combined, it's 86.4 versus 100 almost. And the same thing, you look at the 10-year averages, you see 88 versus 101. So it's not abnormal to see because captives are ready for these high severity cases, and that's why we see the combined ratio spiking for 2017.
Okay, I want to start a question with you, and then I'm going to go to Michael after this with the same question, which is you had some broad numbers on the number of captives globally, and there are quite a few. How about most recently, any changes in terms of numbers or types of captives being formed that you're observing?
Exactly. If we go back to Exhibit 1, which is again based on the information that SRS provided, we see the new formations both in terms of domestic and international to be at 441. At the same time, there were closures, but the closures doesn't mean that the captives went out of business or they were impaired for any reason, although there may have been some. But it's mostly a function of mergers and acquisitions, especially with big companies. And that's one of the reasons that you see changes there.
Michael, is that a typical year or anything driving the numbers either way?
No, I think that in general, for smaller captives, there's been increased scrutiny on sort of the tax profile of smaller captives, and has had sort of slowed the growth of those entities. For larger captives, I think it's a fairly mature market, large corporates, and as Fred mentioned, when there's acquisitions, oftentimes there may be two captives involved, so they merge into one, so you're going to see a natural attrition rate. What we're seeing in terms of growth is a lot of for-profit structures coming in to play, entrepreneurial type captives, right, where there's an opportunity to market insurance to an affiliated part of the business. For example, a cell phone carrier may sell cell phone insurance, partner with the commercial market, and then place that risk into a captive. So we're seeing a lot of opportunities where there's some insurance is tied to the core business in some form, and the client is getting comfortable with risk and just deciding to retain it and finance it in a captive. So a lot of our activity recently has been those opportunities we're seeing. We're also seeing significant growth in medical stop loss programs, where the client takes a certain retention, they'll finance a layer above that within their captive, and then they buy catastrophic protection from the reinsurance market. So those are sort of the areas we're seeing a lot of activity.
And where are those captives being formed? Any trends in terms of domicile selection?
I would say for SRS internally, there's growth, more growth domestically than there is offshore. There's continued growth offshore, but I would say 80% of our new captives are being formed onshore, and part of that is additional tax compliance from going offshore, and a growing sort of robust market onshore. There's so many captive domiciles now, so oftentimes things like self-procurement tax come into play where you want to go to a home state for your captive. But in general, we're seeing most of our captives, I would say the majority of our captives are being formed onshore, but we're still seeing growth offshore as well.
Okay, well, we'll return to that. Maybe we'll talk a little bit more about some of the tax changes and other issues that seem to be changing the market in some degree. Ed, could you talk a little bit more about, drill a little bit into HAI? First off, where are you domiciled?
So,
who are your insureds and what do you provide for them?
Sure. So largely we were formed in 1986 during the insurance crisis for housing authorities, where they couldn't find insurance, it wasn't available, or they couldn't afford it. We began our risk retention group then out of Vermont, and we then started with liability insurance with that. We expanded to property, stayed with public housing, and still are with public housing. That's our core business. We've been in business for a little over 30 years and have been very successful. Recently, that business has evolved from traditional public housing to include a different aspect, which is called affordable housing. So they have different funding sources and different insurance needs. So we, being a captive and a smaller organization, we're pretty nimble. We've been able to adapt to their changing environment and provide more products and services to them to stay with that risk.
Okay, and bring up an interesting point. 1986, of course, was a famous year for RRGs, of course, and it all grew out of the fact that there was hardly any capacity at that time. Since then, you obviously have cycles, but today, plenty of capacity, plenty of competition among insurers, reinsurers for terms of availability. How do you distinguish yourself from that?
Well, superior service is how we distinguish ourselves. We've had a retention ratio of about 97% every year. And keeping service as a priority for us, anticipating the needs of our members and addressing them with the products and services that they need is paramount.
And as you look forward a few years, do you see yourself going into any new areas or services, products?
Yeah, well, right now we're in the beginning stages of establishing our excess and surplus lines company. So we have a variety of companies and products and services to address the needs of our group. We have an admitted carrier, we have a risk retention group, we have a mutual, we have a full agency operation. So we are a one-stop shop.
Okay, Michael, same general question, which is, given the plentiful capacity and competitive terms out there, why do clients choose captives or RRGs, whatever they happen to be into?
I'll echo what Ed mentioned, was just that service and customization is what we're seeing. In terms of, some of our group captives, for example, when you become a member of a group captive, you're purchasing a real customized product. So, for example, we have a restaurant program, and all of the loss control it's a homogeneous group, and all of the loss control is focused on the restaurant exposure. So oftentimes, competing with the traditional market, you're getting sort of a generic product versus a customized product that's specific to you. The coverage areas are specific to the restaurant owner. So I think in general, it's more information, transparency, and long-term stability is sort of keeping captives active and keeping them growing. I think people are getting comfortable with over time. Basically, if you get comfortable with your risk and focus on proactive loss control, then the embedded profits in the program would ultimately go back to the insureds over time. And so they're a little bit less sensitive in terms of price sensitivity initially. So that's what we're seeing, is sort of that belief in over the long term, if you focus on your proactive loss control and you're a cohesive unit, then it's going to be a good decision over the long term.
I would add to
Yeah.
that, just loss control is the cornerstone to all of our programs since the very beginning. Even the extensions and enhancements we have to providing that insurance is we have online learning network that's available to our members any time of the day or night. And it's an extension of our risk management and loss control programs. But to get back to one of the other advantages and things to remember with captives is we're generally mission-based. And the traditional market is more of an opportunistic market. So they can come and go more frequently than we do. We're in it for long-term value.
Okay.
Yeah, in addition to what Ed and Michael said, I mean, you look at the numbers, they speak for themselves. I mean, why would these guys go to commercial market and not save the $5.4 billion that I mentioned, for the small universe of 140 companies? I mean, they retain the members based on these dividends that they give to them, and they increase their surplus to be able to do other lines or give themselves more capacity on doing other things.
Okay.
I think one other piece, just a tangible example, is we have a trucking firm that has a captive. So they've studied their exposures over time, and technology has come into play. So they're within their trucks, they've heavily invested in loss control. So when there's a certain acceleration in a truck, there's an alarm goes off. If there's an accident, there's cameras involved. So they've spent significant resources on building the loss control. So their view is, naturally, we think our risk profile is going to improve, so why don't we retain additional risk? And so it's that thought process of studying your exposures, proactive loss control, using technology where needed, increasing your retention, and then financing it in a captive. It's sort of the process that we see a lot of times with entities considering captives.
Okay. Susan, in your conversation with the captives that you speak to regularly, what role is taxation playing these days? And I think of two specific issues, obviously U.S. tax reform and the BEAT tax too. We hear it mentioned, but is that actually driving business decisions?
Well, I think for companies, we put out a paper earlier this year that basically said, from a rating perspective, tax reform hasn't impacted any ratings of captives. However, when you look at captives and what they're navigating through on tax reform, we're looking at it in terms of their business decision that goes into ERM and their handling of regulatory risk. But it is in many ways a cost of doing business, And you may have, it may impact choice of domicile. I think we have seen cases where there are new captives being set up onshore where they might have had one that was offshore. But then by the same token, you'll also see in places like Bermuda, companies have made the 953D election where they're already being taxed as a U.S. Taxpayer. So tax reform doesn't really affect them. And in terms of the BEAT tax, I think that's part of a wider issue because that's looking at payments, tax receipts globally. So it may not be specific to a captive particularly, but if it is a captive of a multinational company that has a number of entities operating globally, they may be caught up in that unintentionally, so to speak.
Michael, what are you seeing? Are tax issues driving anybody's strategy these days?
I think in the U.S., if you're, self-procurement taxes often drive where the captive is located. If it's located in the home state, the tax reform, the impact, we haven't seen much change in our captive operationally. Obviously, there's more net income being generated, but in general, we're not seeing that. I think oftentimes when we complete a feasibility study and you're working with a client and they're determining whether to go onshore or offshore, and is that driving? Sometimes the tax complexity offshore impacts that decision, that 953D election and the additional requirements associated with that. But oftentimes it's other business issues and business interests that are driving it, and the tax is not a significant factor because, as Susan mentioned, basically if you take that 953D, you're being taxed as a U.S. taxpayer anyway. So it's I'd say in general there's a focus always on this issue, but oftentimes the risk management and the business issues are driving decision making.
Do you see many changes in domicile for established captives, either onshore, from offshore to onshore, or even within the U.S.?
We see periodic redomiciles, and it may be a situation where, for example, Texas. Texas passed captive legislation a few years ago, and there were a lot of large corporates based in Texas that had captives located elsewhere because Texas wasn't a domicile. So we have seen that type of activity. So when a new domicile forms in the U.S., I think there's a natural movement to bring the captive to the home state, and it's part of a positive relationship with the local state, but also supporting local business. So we have seen that type of activity, especially when a large U.S. state passes captive domicile legislation. We've seen a movement to that state.
Okay.
We've also noticed that in May, Vermont actually signed a law that affiliate reinsurance companies can come to offshore. So it's too early to tell how many of our companies might be affected. So it's one of our missions to go when we are with the commissioners in Vermont. We'll find out if there has been any activity there.
Okay. Through AMS TV, we get to a number of captive events, and one of the things that many of the managers have been telling us in recent years is they've been expanding their portfolio to include, first it was employee benefits, heard a lot more about that, and then of course cyber. How much of that is actually going into captives at this point? Any idea?
We've seen a significant growth in cyber and retaining it. And the program, the approach we've seen is, especially larger corps that are purchasing cyber now, potentially taking a quota share of the risk within their own captive. Similar to that trucking firm that I mentioned, I think a lot of companies are investing in their IT infrastructure and getting comfortable with that exposure, and then deciding, okay, let's retain a portion of it in our captive. So cyber has definitely been one of the growth areas that we're seeing.
And do they generally truly cover that, or do they mostly reinsure that?
Oftentimes what we're seeing is, especially with the large corporates, it's taking a quota share of the existing commercial program, so they're following form on a reinsurance basis. So they still, what we're seeing is large corporates still value the loss control. If an event occurs, having a team to come in and handle the cyber situation. So a lot of the insurance commercial coverage includes this proactive loss control team that will spring into action once an event occurs, and that's really valued in the commercial market. So what we're seeing is they're maintaining their core program, but just sharing the risk with the commercial market through a reinsurance placement to their captive.
And how about yourself?
Yeah, and so for us, cyber as well is a concern, but it's pretty interesting. In terms of cyber, it's not only the member and the program we offer to them, we partner with another carrier for, but it also affects us as a company. So in addition to the risks that we have a lot of information. We have regulatory pressures. A lot of the states are mandating certain actions be taken. And it's a pressure on us for our operations as well as being able to provide a product for our members.
Is it something that you think you'll be taking, assuming regulators are good with it, is something that you see yourself and your peer captives taking more of?
I would imagine yes. The reason there isn't a big push to take more of it now is there's no statistically significant data yet to give us assurances that we know what we will provide will be effective. So until we get a little more data, I think we're a little apprehensive to own it in-house.
Okay. Fred, let's talk about investment returns for a minute here. Are we seeing any, do captives seem to be doing anything different than traditional companies in terms of how they're investing, and do their results seem to be as good or even?
Before I answer the investment, can I spend 2 minutes on the cyber thing?
Yeah.
We have seen from our rated captives that it takes them years. So in other words, they don't make a decision tonight that they're going to have cyber in their portfolio. It takes them years to actually study this. And it's not only limited to cyber, but employee benefit and all that. So there's a huge gap, a few years actually, between the thought of including a line into the captive and actually putting it into the captive. And that's the point, the important point that I wanted to make. In terms of investments, we have seen the returns on the investments for the captives are lower than the commercials, but it varies between single-parent captives, which is actually higher than the commercial market, and RRGs, which they try to put it in a safe place and just be conservative. But overall, I think we've seen investment returns to be a bit lower than what commercial market earns.
Okay. Michael, any particular trends in how captives are handling their assets and their approach to?
Well, I think, continuing what Fred mentioned, the lower performance. Oftentimes, if you have a large fronted reinsurance program, then the assets in the captive are in a collateral or reinsurance trust. And sometimes that front company will restrict the investment approach. So you'll have a more conservative approach naturally and lower returns. I just think our captives are looking at it more and more and trying to do interesting things. We're seeing an increase in equity basically as a slice of the overall investment approach. So I think our focus has been just a well-diversified portfolio. But in general, oftentimes the captive is not solely making that decision if they have a large reinsurance trust that's supporting a collateral in a program.
Ed, any thoughts in that area?
Yeah, I would just echo Fred's comment. We have a very conservative investment portfolio, so our returns will be less than the standard markets.
Okay, I just want to mention also that I've been notified, since we mentioned it last time, that the report on which part of the information is based on will be out today. So if you have any questions about that, send an email to webinars@ambest.com and we'll get your response. Quick question on legislation. There's a House Bill 6292, which would expand the types of commercial insurance that RRGs could offer. Do you have a position on that?
Yeah, well, I would support that. It's been a very long and difficult battle.
And where do you see what are the things that they ought to expand into that this would enable?
Well, reports like we just heard from AM Best, year after year, RRGs outperforming standard commercial markets.
Rated RRGs.
Rated RRGs. It's a great testament to how well they perform their business. what it would do is expand capacity in the market. So we believe that we've run our programs very well, and certainly what we see in this report is a reflection of that, and we think it would be a great opportunity to extend into property.
Michael, what do you think? Is it something that members or people you work with would take advantage of?
Yes, yeah, no, I think there's a lot of well-managed risk retention groups out there, and
Sure.
I think an approach where it's evolution and it sort of expands over time would be a thoughtful approach. But I definitely think there's very capable risk retention groups who are expanding their product lines and delivering those additional coverage lines to their insureds.
And what lines or coverages would they most want to cover that they're not able to cover now?
We've seen a desire to go into property.
Yeah.
Obviously, liability is the core, so a lot of our activity is in the medical professional liability, but we've seen a desire to expand into property as one of the areas that our risk retention groups would definitely be interested in considering.
Is workers' compensation included in this bill or no?
Workers' compensation, I'm not sure if it's.
I don't think it is. Yeah,
I think it's property.
property. Yeah.
Okay, and just sticking with legislation and regulation, are there any moves afoot, proposals, new regulations that are going to have an impact or that you're keeping a close eye on, Michael?
No, I think, Ed can speak to this, but the Model Act, and the expansion of that, we're seeing that on a daily basis as you manage risk retention groups. There's definitely more scrutiny coming from regulators in terms of the operations, the governance of risk retention groups. So that we're monitoring that and watching that, but we definitely see an uptick in regulatory oversight of the risk retention groups that we manage.
Any particular regulations or changes? No, as I mentioned earlier, I think cyber right now has still got a lot of our attention. You have New York State DFS and other states are kind of piggybacking onto the regulation and maybe adding some nuances. So while you may meet one, another state may say, oh, that's acceptable. However, you have to add a certain number of products to it, protection.
Okay. On that, always curious because when you talk to regulators, they're obviously many of them work closely with RRGs. Some of them are a little more skeptical than others. Are you seeing the regulatory environment and the position of regulators change in any way?
No, I think there's the Model Act is what we have seen the most impact on in terms of risk retention groups and just domiciles wanting to comply and wanting the RRGs that are registered in that state to comply with those guidelines. So I think just a general focus on governance and certain operational procedures on collateral related to reinsurance relationships, especially if it's an affiliated insurer. So I think we've seen an uptick in oversight and review, but I think for the most part it's been thoughtful, good regulations in terms of managing the exposures of a risk retention group.
Okay. We're coming to the end of our discussion here. I'd like to close out with a question for each of the panelists. It's just a very general one, which is season starting again. The next conference that's coming up for captives is Vermont. There are quite a few others throughout the year. Each year seems to take on a different theme as far as things people are focusing on, things like cyber, sometimes tax reform and all that. What do you think would be the major points of discussion at Vermont coming up?
From my perspective, I think it's sort of the captive is a maturing market. So the question is, where are the next growth opportunities coming from? And I think, what we're seeing on, at least internally, is medical stop loss and sort of entrepreneurial type programs or for-profit type programs is what we're seeing in terms of growth areas where people are just, I think in general, what we're seeing is companies are getting more and more comfortable with their risk and wanting to retain more and more. So it's an interesting relationship. If you have a captive and a large balance sheet, your interaction with the commercial market, because you're trying to expand your retention capabilities, and the commercial market is your partner, but basically as you're expanding your profile, their profile is being reduced. So I think one of the key longer term things to consider is that relationship between captives and the market, and what's the right balance of catastrophic protection from the market and the cost related to that, as these captives grow and develop and want to take on more and more risk. It's good. I think the relationships are going to change over time, and it's going to be an interesting dynamic as we move forward.
Okay, Susan, what do you see as the key points that are going to drive captive discussions this year?
I echo Mike's comments on, you may have some newer captives that'll be up in Vermont, but there's also some long-established captives. So I think there'll be a good information on hot topics. I think specifically we'd want to talk about, we'd want to hear more about innovation and what captives are doing in that space. Captives have done very well at managing expenses, and the more that they can utilize technology to do that, I think that would be something very good to further control their costs. But they're so close to their risks that harnessing data is something that's key for the captive strategy.
Okay, and Ed, when you're out, what are you hearing? What are you talking about?
I would say being nimble.
Okay.
There are a lot of political and economic changes going on. If you're in a captive, you have a homogeneous group, it's unlikely that things stay the same for them. So you have to be nimble enough to move and evolve with them.
Thank you. And Fred?
Past few recent conferences that we have attended have had a special session for the millennium. Young people, attracting them to captive industry and insurance industry in general. And I think, that theme is going to be repeated in Vermont as well.
Okay. Well, thank you, Fred, Ed, Susan, and Michael. A very enjoyable discussion. We'll have this webinar posted for replay certainly by tomorrow morning, perhaps this afternoon. Thank you for joining us. As I mentioned, the captive report will be out today. If you have any questions on that, send an email to webinars@ambest.com. I'm Lee McDonald for the AM Best Company.